Not so long ago, Polymarket gave the Clarity Act an 82% chance of becoming law. That same bet, though, is now sitting somewhere between 38 and 46%. Confidence in what was supposed to be the most important crypto law in American history is disappearing fast. Senator Bernie Moreno has now said that the bill has to pass Congress before the end of May, or it will fail completely.
Fail!
Meanwhile, Senator Cynthia Lummis has warned that if they miss this chance, the next opportunity for major crypto legislation might not be until 2030 or later. Those who work on Capitol Hill and the lobbyists closest to the action are now saying the chance of Clarity passing is only 26%. So today, we're going to figure out exactly what is secretly killing this bill, who is fighting who, and what happens to crypto in America if this whole effort collapses in the next 4 weeks. My name is Guy, and you're watching The Coin Bureau. Throughout February and most of March, almost everyone in the crypto world thought the Digital Asset Market Clarity Act, or just Clarity, was pretty much guaranteed to pass. Patrick Witt, an advisor to the White House, had publicly stated that the big problems in getting the law passed were quickly being solved. Ripple CEO Brad Garlinghouse was telling people that the odds were between 80 and 90%. The Genius Act, legislation governing stablecoins, had passed in 2025. The House of Representatives had passed its version of Clarity in July of that year with a vote of 294 to 134. And everyone expected the Senate Banking Committee to finalize their version of the law during April. Then, the schedule started to fall apart. On the 9th of April, the Polymarket odds dropped from the high 70s down to about 61% when the first signs of the committee delaying their schedule began to appear. They briefly went back up to 64% on the 18th because traders thought there might be a chance for the committee to work on it late in the month. But then, around the 18th to the 20th of April, Senator Thom Tillis formally asked the Banking Committee Chair, Tim Scott, to postpone the work entirely to allow for more discussion. The Senate's schedule was already full with the confirmation hearing for Kevin Warsh as the Federal Reserve Chair, which was planned for the 29th of April. So, the April deadline, which the whole industry was counting on, was basically gone.
It's gone.
Now, all this uncertainty around the bill comes down to one technical question. It might sound boring, but trillions of dollars held in banks depend on the answer. That question is whether companies that issue stablecoins and the platforms that sell them are allowed to pass on any kind of interest, rewards, or yield payments to their holders. Traditional banks see any stablecoin that pays its users as a direct competitor to the money people keep in insured bank accounts. Standard Chartered has estimated that if stablecoin interest isn't restricted, it could potentially pull as much as $500 billion out of the regulated banking system by 2028. And understandably, the banks aren't too happy about that number and have united in opposition to the bill. A temporary agreement was reportedly reached in March and April between Senator Tillis and Senator Angela Alsobrooks, with help from the White House. Now, this plan would completely ban the simple passive earning of interest, but would allow rewards based on activity. So, think of it as the difference between earning interest on a savings account and getting cash back when you use a credit card. However, that agreement is shaky. Bank lobbyists, especially those talking to senators from states with a strong bank presence, have been pressuring members to completely rewrite the language. Now, Tillis represents North Carolina, which is where Bank of America has its headquarters, so the political pressure on him to side with the banks is intense. And even if that agreement stays in place, the bill still has to pass 5 steps before becoming law. The first is the Senate Banking Committee officially finalizing the bill, which still hasn't happened. The second is a full Senate vote, which needs 60 votes to stop a filibuster. This means at least 7 Democrats have to vote for it. The third is combining it with the version being created in the Senate Agriculture Committee, which controls laws for digital assets classified as commodities. The fourth is combining it with the text the House passed in July of last year. And the fifth is getting a presidential signature, which President Trump and Treasury Secretary Scott Bessent have both publicly promised to do if the bill ever makes it to the Oval Office desk. But each of those steps requires time on the Senate floor, which the Senate simply doesn't have. Right, folks, a quick interlude because I think you're going to want to know this as well. Now, a lot of people still think Coinbase is just a beginner platform, but with Coinbase Advanced, that's actually changed quite a bit. You're getting lower fees, proper charting tools, real-time order books, and full control with limit and stop orders. So it all feels much closer to a professional trading setup, but without the usual complexity. So whether you're stepping up from basic apps or just want a cleaner, more reliable platform, it is definitely one to have on your radar. And if you want to try it out, there's currently a limited offer for Coin Bureau viewers. You can get $40 in Bitcoin when you trade $40. Now, this is available in the US, Canada, Europe, Singapore, and Australia, but it's capped to the first 350 people, so it may not last long. You can scan the QR code on screen now or check the link in the description and pinned comment for full details. And with that, let's get back to it. So, when you look at the professional trading firms that are literally betting their reputations on a probability number, the outlook is pretty serious. Galaxy Research, through analyst Alex Thorne, currently puts the chance at roughly 50%, the most hopeful of the major firms. But Galaxy adds an important condition to that estimate. If the banking committee's work slips past mid-May, Thorne has clearly warned that the probability of the law passing in 2026 will, in his words, quote, drop sharply. TD Cowen's Jarrett Saberg has formally put the odds at 33%, and his reasoning is the most detailed case for why the bill might fail. He mentions that the CFTC, the agency that would regulate much of the crypto industry, currently only has one commissioner, which makes Congress hesitant to give the agency much more authority over digital commodities. He mentions the problem of rules for prediction markets getting tangled up, which threatens to drag in worries about conflicts of interest related to the Trump family's financial holdings. He mentions ongoing news about World Liberty Financial, the Trump family's crypto venture, that has made the legislation harder for Democrats to support. He mentions pressure to make anti-money laundering rules stronger following reports of Iran trying to use crypto to avoid sanctions. And he mentions the threat of unrelated, controversial parts called poison pills, like the Credit Card Competition Act, being added to the package, which could destroy whatever stablecoin agreement Tillis and Alsobrooks have managed to put together. Meanwhile, Wintermute's policy leader Ron Hammond has put the figure at 30%. He mentions constant disagreements among Democrats, fragile negotiations, and a situation where current administrative guidance and selective enforcement are reducing the urgency that would otherwise force a deal. And then there is the most negative piece of information in the entire research file. A Punchbowl News survey of lobbyists and congressional staffers, the people who actually work on Capitol Hill every single day, came back with a figure of roughly 26%. Now, when the people closest to the lawmaking process itself are betting lower than the big professional firms, that is a warning sign worth paying attention to. Now, the crypto industry's response to all of this has split into two different groups. In the optimists' corner, Mike Novogratz has publicly insisted that the bill will get done in May. JP Morgan has noted that the number of disagreements has shrunk from over a dozen down to just 2 or 3 main questions, suggesting the bill is close to what their chief analyst called a, quote, final breakthrough. A group of more than 120 crypto firms, including Galaxy Digital, sent an emergency joint letter to the Senate Banking Committee on the 23rd of April, demanding that they finalize the bill immediately. Meanwhile, over in the pessimists' corner, Mark Yusko has called the legislation a, quote, horrible bill that will strengthen the very institutions crypto was designed to bypass. And a growing number of analysts are openly questioning whether any agreement that can get 60 Senate votes can possibly satisfy the core interests of the crypto community. And now this brings us to the part of the story that almost nobody outside of Washington fully understands. If this bill fails in May, it won't just move to June or September or even early next year. The November midterms will almost certainly completely change the balance of power in the Senate. A new Congress means new committee assignments, new leaders, new ways of negotiating, and the very real chance that the political environment that made this law possible in the first place will no longer exist after the midterm elections. This is exactly why Senator Lummis has mentioned the possibility of waiting until 2030 or indeed even later. A 4-year period with no new laws during which American crypto firms would continue to operate under the current confusing mix of SEC enforcement actions, fights over who has authority between the SEC and the CFTC, and different state rules for money transmission is not a neutral result. It's a result that has historically pushed developers, money and infrastructure out of the country. We've already seen that happen over the past several years, and a failed Clarity Act likely locks that in for the rest of the decade. So, the honest truth is that the Clarity Act is now in a very dangerous position that nobody, not betting markets, not the professional firms, not the senators themselves, can confidently predict. The Memorial Day break starts on the 21st of May, squeezing whatever working days are left into a window that is measured in days of legislative work, not weeks. The agreement on stablecoin interest is fragile, the banking lobby is actively fighting it, the CFTC is working with limited staff, and a single procedural delay between now and mid-May could push the entire effort into a 2027 Congress that might not have the political desire to even look at it again. So, what was an 80 to 90% certainty back in February has become a coin flip at best and a 1 in 4 shot at worst in the span of roughly 10 weeks. The kind of drop you only usually see in crypto, ironically enough. But what do you all think? Will the Senate find the political will to push clarity across the finish line before Memorial Day? Or are we watching the most important piece of American crypto legislation in a generation die a slow, lingering death over the next 4 weeks? Let me know your thoughts in the comments down below. And if you want to understand exactly how the Genius Act stablecoin framework set the stage for this current fight and why its passage last year created the very banking industry backlash that is now strangling clarity, then you can check out our full deep dive on that legislation right over here. Okay, thank you all so much for watching, and I'll see you again very soon. This is Guy, signing off.